where everything was going .com. And how many of you thought that, or the .comers said that you were all going to be pools of oil like a dinosaur because real estate agents would not be necessary anymore? I see you're all still sitting here. But the jury's out on what's going to happen with all of these expansions. Because remember one thing, these expansions have happened since the market started healing itself. And it didn't take much intelligence to sell a house over the last 2 or 3 years. If you got a listing and you put it on the market, the damn thing sold, and it sold quickly. What's going to happen when the market shifts? And as long as I've been in this business, I've gone through 4 or 5 shifts, some of them very painful. It's going to be interesting to see what these disruptors happen to them when the market does take a shift.
I think it's important to note that the consumer's changing. And whether or not you look at a micro market from a demographic age standpoint, from a ethnic background, whatever, you guys, I think, are fully aware that the marketplace is changing. How many of you guys even know what a concept like Opendoor is? So
raise your hand if you've never heard of Opendoor.
You're going to hear about it. They are not in this marketplace right now, but basically they've taken a model. It's not a new model. There's really truly nothing in real estate that's new under the sun. But what they've done is they've applied some Wall Street expertise and technological expertise into a process by which they are going out and offering directly to the consumer that they'll buy your house for cash. And what they do is they quickly turn that around within a 30 to 60 day time frame through the multiple listing service and sell it back out, and are making profit off of the spread they're getting in between what they're offering to buy your house and what they're charging, which is a 9 to 12% fee for this ability. I will tell you, in the Dallas marketplace in December, they moved 990 homes. And they did that with a sales force of 8 people. So recognize
There's our 95.5, guys.
Yeah, recognize that there are a number of companies out there, one called Knock, one called OfferPad. They're all doing some essential variation of this concept. You guys, some of you raised your hands with the Zillow Instant Offer concept. This is that on steroids. And in the marketplaces that they've walked into, and right now they're in 4. They're in Las Vegas, Atlanta, Dallas, and Orlando. So, I'm sorry, Phoenix, they're in 5. So they're in the process of opening up to more marketplaces. If you look at the money that's being thrown into technology in the real estate business, in 2017, that number was about $3.6 billion is what we're looking at. So Wall Street is definitely got its eyes on the real estate industry and what's going on, especially when you look at just from a GCI standpoint, your business is a $50 to $60 billion a year business across the country.
You had said that the consumer's changing. Are the realtors changing, Mark?
Not fast enough. I mean, one of the challenges is, if you think about it, I would suspect almost everybody in here buys off of Amazon, and probably most of you are Amazon Prime members. I mean, the idea of buying things online may have seemed kind of odd or unusual 10 or 15 years ago. It's not the case now. Everybody buys things online. Now, that's not saying the transaction and our role as realtors is going to be replaced by the internet. Largely, that's not the case. People fundamentally need someone to shepherd them through the process, because buying a house is A, very complicated still, and B, very risk associated. So it's a risk management issue. I mean, I know people, a good friend of mine, attorney, does not need a realtor to help him buy a house. He chose to use a realtor because he wanted the risk management aspect of it. So I don't see that changing largely, but consumers are going to change because of what their expectations are and the relationship between how they want to go about the process of buying a house. And if you are not up to speed in managing your relationship with your clients in the most efficient, technologically connected way to the consumer, they're not going to use you. They will find some other opportunity.
And we're really good at that, right? Are we? We are? Well, yes, some of us are. So Interesting. I did get a couple text questions there. I'm going to try to combine 3 or 4 of them together. Companies like Purple Bricks, same but different, because they're not necessarily an instant offer or an open door type thing. And by the way, we're not going to talk commissions and discount brokerage. We're going to run into all sorts of trouble here with that. But that is a different area of disruption with just different business models. I'll just speak for myself. I mean, I look at my business model constantly, and I sit back and say, are we competitive? Not only can we compete, or not compete, forget about compete, can we participate, for example, in Instant Offer? I remember when Zillow introduced Instant Offer, and at the time I was spending a fair amount of money as a subscriber or advertiser in Zillow, and I called him up and said, BS, you're going to do that, I'm pulling my advertising unless I get to be one of the agents, right? Well, and of course, at that time, Instant Offer wasn't in Southern California. It was based in Vegas and Florida. And they said, well, okay, it's just a test model, don't worry about it. And I'm like, okay, well, I want to move to Vegas, and I want to be one of your agents. No, we already got those figured out. Okay. So it's kind of interesting on the Instant Offer. And then from what I also understood with Instant Offer, there was the investment club says, oh, that's fine. I want to be one of the buyers. How do I participate on the buy side of that? Well, at least that concept with Instant Offer said, well, no, we already have our buyers here locked in with the ABC hedge fund, and we've already got our agents locked in over here. But that idea seems to me like that was just a toe in the water. And even though they don't want to disrupt, and they'll tell you, we don't want to disrupt our relationship with the realtors. But that sort of stuff keeps me up at night. Rick, you were going to jump in.
You know, one thing I'd say to you guys, the real estate business has changed dramatically over the last 30 years, and it'll continue to change. The key in it for you as practitioners is that you need to change along with the marketplace. And that means that you have to have knowledge of what's going on in the marketplace. I used to tell my agents every year at our meeting when we talked about the marketplace, the market's the market. I don't care what you want to do with it. I don't care how you feel about it. The market is the market. Your response to the market, it's like when people throw stuff at you. It's never what people throw at you. It's how you catch it, how you respond to it. So has Zillow done a good job? Yeah. Has Amazon done a good job? Yeah. Has Google done a good job? Yeah. I got a buddy of mine who was one of the founders of Home Depot. Home Depot you'd think would be in big trouble, wouldn't you? They got all those big stores. They were smart enough 15 years ago to really put a market presence on the internet. And their business off the internet is absolutely huge. And Home Depot stock to this day is a very, very good investment. So when you think about this stuff, be a sponge. Learn what's going on in your local market. That's the most important thing you can do. And once you've learned about the local market, there are a couple of other hints I would give you. Zillow is really good at capturing consumers' eyes. And because they give the consumer a view that the consumer wants to see, they build loyalty within the consumer. And then they go back once the consumer is engaged, and they solicit the consumer for more. Anybody ever gone on MSN for the news in the morning, and yesterday you went to Home Depot and you looking at buying a shed for outside in your yard, and all of a sudden sheds are popping up everywhere on MSN? For God's sakes, does that tell you that these people really have a business plan and an analytic to do things correctly? So I made some notes because Lance told us we could make notes.
I did.
First thing, I just helped someone with some advice on selling a house in another part of the United States. Third generation of that family that I've helped. I've done over 50 transactions in my career with that family. What does that tell you guys? Zillow is really good at making people love them. We're not so good as an industry making our really happy customers love us by continuing involvement with them. We got to be better at that. We have to service the customer, not with just good customer service, with exceptional customer service.
Let me interrupt you for a second on that, Rick. And that's one of the reasons I'm concerned about our model, because if we have a certain number of, and by the way, if you're a highly productive agent, or at least if you're in a zone where you're happy, I mean, we don't all have to close 1,000 houses a year. I mean, if your business model is I want to do 2 or 3 and I'm happy with 2 or 3 and that's kind of where I'm at, then God bless you, that's great. But I think most of the agents out there that are doing 0, 1, or 2 or 3, there's no follow-up with the rest. They're not doing 50 transactions with those people that they worked with 7, 9 years ago. They're forgotten. Which is why I just think the agent pool is going to get just smaller. As far as the producing agent pool is going to continue to get smaller and smaller
but the
and smaller.
people that are doing the 50 deals a year are the people who are giving the love back to their customers.
Correct.
Think about it.
Which, getting back to that C21 ad, again, to give them some love with my logos all over the company with CB, I love that commercial because it's a, yeah, we got to do the technology, but we're people, and we're here to provide some service. Okay, we got a few minutes left on this. Again, this is one of the dangers of doing these short panels. It's like, God, I could go on forever. So what do you guys see? Okay, let's talk economically wise, because now we're kind of talking industry and agents and all the rest of that sort of stuff. How do you feel about our real estate market? Sales, prices, anything scare you? Is there anything out there from an economic standpoint that scares you? We're member-driven, or at least I'm on the board with IVAR at least for another year. IVAR, at least in part, is member-driven. We want more. CRMLS fees come from members. You guys want more. In some ways, just like DRE wants more agents, we don't want to make it harder to people to get in because that hurts revenue. But just economically, where are we more transactions, less transactions? What are you guys feeling is going to happen in the next 12 months?
I think transactions are going to be a slight increase. I mean, if you look at the last several years, we've seen slight increases across the board. You said it earlier, we're seeing more closings and fewer listings going into the system mainly because of demand. And I suspect that we're going to be looking at a lot of strong indicators for 18. We'll see the same. Not huge. Median sales price for the last 8 to 10 months has been flat. It's been about 1.5% increase. So as long as the economy is there, I think we're going to be in a pretty good position to see a decent market. The issue of inventory, which was funny, earlier you said, we're not complaining about it anymore. I think most of us have just accepted this as the new norm. I mean, 4 years ago, everybody was going crazy about the lack of inventory, but after 1, 2, 3, 4 years, we kind of shrug our shoulders and say, I guess this is what we're going to have to deal with.
Yep.
I'll take it in a little bit different direction. I'm not an economist, and I didn't stay in a Holiday Inn Select last night, so I won't go above my pay grade. My biggest concern for 2018 and beyond is the simple fact that community in the real estate industry is breaking down, and it is unfortunate. It's a direct driver is the inventory issue. It's concerning to me that in some of our micro marketplaces that a lot of the inventory that's available in the marketplace is not showing up on the MLS. Of course, you'd say an MLS guy would want to have all that inventory on the MLS. I'm a firm believer that the MLS is one of the biggest pro-consumer benefits that the brokerage community has ever given. You guys have such a unique thing in the United States. It is duplicated nowhere else in the world. I have countries literally weekly coming across our front door asking, how do we do what you guys have done in the United States? And I don't have an answer for them because you guys have such a unique tool at your fingertips. And I would ask you to think about it long term. We've statistically done the studies, and it's to a detriment of 8 to 10% for your buyers when you do not present your listings on the MLS. And long term, you guys need to recognize that this tool of the MLS is not a technology platform. It's a community that's built around cooperation and compensation. And it is special, and it is unique in this world, and you guys need to protect that.
Yeah. Ever remember the listing agreement a couple of years ago? And then you remember the change on the listing agreement a couple of years ago, and we have this, basically we added an entire new page because it was on page 2, we have this, almost the whole page that's in a box. And when I explain page 2 and that box to my seller, it's an embarrassment that we have to do that. And if you don't know what I'm talking about, then go open up the listing agreement, and it basically talks about the benefits of putting your property in the MLS. And, it might not be such a good idea to be a pocket listing, and why are you holding your property off the market? And there's several of us in this room. I'll throw myself in there, but I'll take myself out of that. Homie, don't play that game, okay? And a lot of you do, and you made a business decision that it's in your best interest in your business to do it. And I'm telling you, if you don't do it right, and most of you don't, you're killing what we have. This is a very precious thing that we have. And I don't think we realize that. And it wouldn't surprise me at any, I mean, this has come around for years, but it wouldn't surprise me at some point in time, somebody gets the courage to get rid of dual agency. It's been talked about ever since I've been in the business. If we keep doing what we're doing, dual agency, we're not going to be able to sell our own listings. And then what you going to do, right? And by the way, that devalues things like Zillow. Because now if I'm getting all my Zillow leads on my inventory and I can't sell my own inventory and I can't give them to my team, now I got to have, boy, that's a whole new business model. Now I got to have a partnership with another. I got to find a way around that. So at any rate, we're 2 minutes over. There was something I wanted to ask Rick, and I didn't. So at any rate.
Can I say what scares me?
Yeah, well, yes, please. What scares you?
What scares me is some little guy in the Korean Peninsula. That scares me. What doesn't scare me is a challenging business environment that changes, because that happens all the time. So short of that guy, I think that we all have an opportunity, depending on how we want to educate ourselves about the opportunity, how intimately we study our competition, how we then explain our value. Because one thing is for certain, if you go to any one of our county recorder's offices at 8 a.m. on any weekday, there's going to be somebody there recording a deed. Even in the worst of times, property still changed hands. The real question is, what are you going to invest in yourself professionally to ensure that you're involved in each one of those things that goes down?
Excellent. Give them all a hand. Thank you, gentlemen.
Based on what you're all expecting. A good friend of mine, Larry Elder, most of you probably know, he says that when he was brought up, his parents used to tell him, hard work wins. No matter how hard you work, bad things happen. And how you handle yourself when bad things happen tells us whether we raised a man or not. I don't know if that has anything to do with market forecast, but it's the best advice I've probably ever heard for every one of you. Since I'm up here and you're down there, you're my kids, so I'm telling you, hard work wins. No matter how hard you work, this mic is going to squeak. No matter how hard you work, bad things happen, and how you handle yourselves when bad things happen is how we know if we raise the man. And don't take that as sexist, women. Man being someone who can handle themselves when things happen. Okay, so I got this. I'm going to try and go through this really fast and try not to be Bruce Norris, but I learned a lot of stuff from Bruce Norris, and I've learned a lot of stuff from most of you out here, because if you're not learning, you're dead. And it's not an accident that I said creating real estate wealth in 2011. I used to give these real estate investment seminars, and in 2011 I was doing this seminar, and I pulled 4 slides from it, and trying to give you a premise of how market cycles work. And in 2011, I was teaching people about market cycles, and I was teaching people, and you see this curve, and we all know that the real estate curve does this, but it really does this, and sometimes they're longer, but I didn't know how to put a chart like that on a computer. So I was teaching people about buyer's market 1, buyer's market 2, seller's market 1, seller's market 2. And just tell me if this makes sense, because then I'm going to compare to where we are today. So got to go that way. Okay, so buyer's market 1, which is where we were when we started doing these things, so we had an oversupply of properties. This was in 2009, 2010. I think I did my last seminar in 2011. I had an opportunity to change that to 2018. I said no, because I don't think this is all pertinent, but I wanted to start with this. Oversupply of properties, bank foreclosures rising to their highest levels. Very little job growth in the area. Is that today? No. And my advice to people at that time, remember they're looking to buy, is buy houses for cash flow, not for appreciation. Why? Because houses weren't appreciating back then. They're still going down. This is when Lance told me, as I'm writing offers on his listings, you're jumping in too soon, buddy. And I said, well, I'm not buying stuff at market price. I'm buying the crappy stuff that nobody else wants, and I'm improving them. I went to a Bruce Norris seminar too. Okay. Buyer's market 2, this was about 2012. This is the bottom of the market. This is when everybody should jump in, and everybody did. Okay, list prices are at their lowest levels. Rents are increasing because people are out. I need a place to live. Competition for bank foreclosures was rising, you think. Expect to pay full asking price or more. And at that point, I was telling people, buy everything that makes sense and hold, don't flip. Okay? Everybody remember this? Anybody trying to buy properties when they were at the bottom of the market? Impossible. If you weren't Maxim Properties or the Norris Group or the Riverside Investors Group, if you weren't one of the select half a dozen people at those trustee sales, you didn't get anything. Hence, Lance, you were wrong. At least I bought some stuff towards the bottom. Sellers Market 1, kind of like where we are now. Okay, uneducated. Let me emphasize. Uneducated investors are convinced good times are here, and that's what they jump in. Anybody experiencing that? Oh, I got to get in now, man. Times are good. I got to buy gold. It's at 1900. I got to buy Bitcoin. It's worth $22,000. Yep. How is it today? Not 22,000. Okay. Properties are selling fast. Bidding wars, offers above the asking price, and at that point, that's when you buy flippers, and or if you find something that cash flows, buy that. Okay. Sellers Market 2. This was 2006. Okay. Hopefully, I don't see this happening in court, especially after Bruce's presentation. I don't see Sellers Market 2 for a long time. But in those, that's the riskiest part of the cycle. Fewer buyers, supplies grow, job growth is slowing, and what we told everybody is investors lock in their gains and protect against losses. How do they do that? Sell their properties and get into other investments. Okay? So with that in mind, there's a few things that we left out that are real in 2018, and that is these three guys. Okay? Love him or hate him, Donald Trump's doing some ballsy stuff that's going to change this economy. And they say, hey, you know, he's doing these tariffs on steel. It's going to be a disaster. Bullshit. It's not going to be a disaster. He's the first one that had the guts to go up to our competition and not kiss their ass. Okay? Hey. Okay. If you hear me on the radio, there's a few words I don't get to say on the radio, but we edit those out after I record. But Trump is unconventional. A lot of people don't like him because he's making decisions like a businessman. If you remember 1992, for those of you that are old enough to remember that, we had Clinton, the sleazebag, and we had George Bush, who was tired from being beat up over the Gulf War, and we had Ross Perot before he got out, and everyone said, Ross Perot makes so much sense. He's a businessman. And then he got out, and we go, I don't know that he's serious, and he got back in, and he got slaughtered. So, but that was the case. Now we've got Trump, and he's not going anywhere. Okay, you don't like him? I don't care if you don't like him. The stuff he's doing is going to fix things. Okay, tax relief. You know, the National Association of Realtors and everything that we're saying about how tax reform is going to be a disaster. Guess what? People don't buy houses for tax breaks. You know why people buy houses? 2 reasons. Number one, they want to own. And number 2, they have jobs. And guess what? Well, the tax breaks have been out for 2 months. I haven't seen a raise at my job. I haven't got my $4,000. Guess what? Give them a chance. I think the tax breaks are going to increase employment. They're going to increase income. They're going to increase all that stuff. But it's not going to happen for a few more months, maybe next year. But we have to make. Trump didn't get in to fix the world today. He's fixing it for. Anybody got grandkids here? Okay, they're going to be the recipients of everything that we're doing today in Washington, D.C. Or that they're doing today in Washington, D.C. Okay? This other guy on the left is Jerome Powell. He's the new federal chairman, head of the Federal Reserve. The only reason I put him up there is so I can remember to talk about interest rates. Interest rates are going up. Interest rates have gone up. Okay, what does that mean? Refinance market is gone. Does that mean people won't refinance? No, people that want cash out are going to refinance. If you're a lender, reverse mortgages. Because there's a bunch of baby boomers that don't have any money. They got a lot more life left, but all they have is equity in their house. They don't have any money to retire on, so they don't get to retire. Okay? I'm thinking about retiring, but I just don't know what I'd do if I was retired. So I'm going to hang around for a little while. So be aware of that. Interest rates are going up. Interest rates are going up. For you realtors, hey, have some urgency. When someone says that they want to buy a house, you kick them over to your lender. Oh, I'm already pre-qualified. Make sure you have a partnership with a lender that has a brain that can really tell you, hey, they qualify. I saw their taxes. I didn't just go on what they told me. And say, hey, these people are qualified. Put them in your car. You know why realtors have 4-door cars? So you have room in the front seat and the back seat, because you can't put husband and wife in the front in your bucket seat in your Corvette. Okay? 4-door cars, stick the husband and wife and their kid in there, and go show them some houses. And write them up. Okay? Because the interest rates are going to go up. When the interest rates go up, their qualification goes down. So if we tell you, hey, today at 4.5, they qualify for for $380,000, and you wait till you put them on the automatic email thing for a couple of weeks and say, hey, go look at these houses, tell me which one you want to see, you're losing it. You're losing it. Okay? Put them in your car. This guy on the right here is Mick Mulvaney. He's my hero. Okay? He's the head of Office of Management and Budget, and he's the interim director of the Consumer Financial Protection Bureau. Any lenders in the room? Okay? Has the CFPB made your life hell for the last 8-9 years? They suck. Okay? Mick Mulvaney hates them too. He thinks it was an overreach and overregulation, and they put him in there in charge. Richard Cordray, who was a moron. First time I saw Richard Cordray talk, the first thing he came out on stage at a mortgage bankers conference. He goes, "The Affordable Health Care Act is going to save the housing industry." And I sat back there and I just go, bullshit about this loud. And everyone else was silent except for me. And my wife, everybody turned around and looked. You guys are all thinking it too? After I recovered from the elbow I got in my ribs from my wife. Mick Mulvaney hates this place. You know, he asked for how much do you need in your budget this year. He said $0. We have $177 million in a slush fund from money we've extorted from Bank of America and Citibank and Chase. Why do we need any more of our taxpayer money? We'll make it work on this. Does that make you feel good about where your tax money's going? The half of you that pay taxes? Okay? 50% of people don't pay taxes, so guess what? If we lose the mortgage interest deduction, who cares? You don't get to deduct it anyway. And some of you guys that make over $260,000, $270,000 don't realize it, but you don't get any benefit from it. I said something on the radio that, hey, if you make over $260,000, $270,000, alternative minimum tax takes away the use of your mortgage interest or your property tax deduction on your primary residence house, and I got people sending me nasty grams. Oh, I make more than that. I got all kinds of, I need that. Hey, guess what? When you have your taxes done, if you make more than that, have your tax guy, Brooke, as soon as he does your taxes, and say, here, you pay in $4,800 or $48,000 or $148,000, depending how unfortunate you are, or fortunate, whichever way you see it. And then say, okay, pull out my mortgage interest deduction and tell me how much I have to pay. If you're making over $260,000, $270,000, guess what? It doesn't change because alternative minimum tax takes it over. Okay, so keep that in mind. Keep that in mind when you see this stuff. But Mick Mulvaney is saying, hey, we're gonna ease off on. We're gonna stop going after the people that we're regulating. We're gonna stop penalizing people for for breaking laws. They didn't even know they were breaking the law because it took Dodd-Frank came out in 2009. They're still interpreting it. Okay.
Ed's on our panel, so you got 30 seconds to wrap that
30
up,
more seconds.
and then
Okay.
we're going to put you on the panel. So, by the way, Rich, I apologize. I was told I called you John a minute ago. Rich Macaluso is going to come up, and Gary Martell's going to come up.
You're eating my
So
30 seconds.
I know why they're getting ready. You're going to finish.
Okay.
So
So my last thing I was going to say how the market's going to change. Technology, can't ignore it. They've been talking about it all day, so I'll make it simple. If you guys are relying on technology, you're missing the boat. Okay? You can't ignore technology, but guess what? And I'll quote the Incredibles. If everyone is a superhero, nobody's a superhero. Okay? When Facebook page came out and all these new technologies came out, hey, it was cool at first. Hey, I'm going to go to this company. They have this shiny red secret to making it in the loan business. I'm going to go here, go there. Guess what? You know what makes Ed Hoffman special? Ed Hoffman. You know what makes Lance Martin special? Lance Martin. Okay, Mike Novak Smith. Everybody know who he is? Okay, he used to say, you know why I like doing business with you, Ed? He goes, because when the refinance market is going, you still come in. You still answer my calls. And what's happening now? The refinance market dies, and all those refinance lenders are going to be flooding real estate offices going, hey, can I get some business?
you would think. I haven't seen them, but at any rate, Ed, I'm going to cut you off.
Okay, so anyway.
Gary, John, come on up. So this is the deal. We got a couple lenders. We got a title guy. And we're going to talk some industry stuff as it relates to. I want to start with the interest rate thing because I was a little surprised that Bruce didn't kind of back off of his 2%. If I heard him, did anybody hear something different? It almost sounded to me like he's saying, yeah, at some point in time we might actually see 2% interest rates.
I think you meant the Fed funds rate.
Well, Well, I don't think he was talking about the Fed rate, because at the time he said that the funds rate was like 0 or a quarter. But anyway, let's just take just 1 minute, and let's just kind of go down the road. And I think, Gary, you kind of already addressed it, but let's just take a minute. Where do we think interest rates are going to, I want a number. Where are we going to think interest rates are going to be at the end of the year? And if you just have no idea, then I'm fine with that. But if you're willing to take a guess, let's take a guess.
So just a guess, somewhere between 4 and 12. No, actually,
Bold.
Everything that we see shows the rates should still continue to creep up. Pressure depends a lot of economic news and whatnot. But Feds will raise their funds rate 3 times probably during the year. And there will be pressure on 30-year fixed rate mortgages as long as things roll around. Probably another 0.25% higher than where we're starting now.
Do we think any of that's already baked in? If it was, do we feel it's baked in? No, I got 2 yeses and a no.
I think
Yes.
so. I think we might end up 5.25 for 30-year fixed. I don't think it'll go any higher than that because at some point, Jerome Powell, Trump will say, "Hey, let's slow it down." We've got some smart business guys in there that know that hey, they kept lowering and lowering and lowering to stimulate. You can't get any lower than 0.
I'm looking for Mark or somebody who follows CAR and Leslie and Joel. What is CAR saying interest rates? What is their forecast for interest rates this year? Gene, do you know? Connie? Anybody? Anybody know? They put out a forecast that says something. I think it's around 5. 5. Okay. But you said, Gary, you're going to be doing loans. 5%, 5.25%. Not going to affect you.
No, I think most of us have seen, especially for those of us that have been in the purchase money market, there is pent-up demand, and people, as they see rates start to go up, they encourages people to get off the fence. And I don't think it's going to affect affordability that much if you see how much another 1/8% affects somebody qualifying.
I know Bruce. Did Bruce leave? Mr. Norris, you still in the building? You guys remember Bruce's 17, or was it 17 or 19%? 17? 17 is his affordability number. I saw Bruce speak years and years and years ago, and he says, as long as affordability is above 17%, we're fine. And I believe the number he said this morning, we're at 29%, right?
Until subprime came in.
Okay.
That artificially altered his, or I should say modified his model, because all of a sudden, even though 17% was where people could afford, and then let's just change the guidelines. So you can afford anything you want.
So are you saying that the number's not 17% anymore?
No, it's back to 17% because we're back to normal lending again.
Okay. Drew, Drake, somebody hit the slide to the next thing. I want to talk regulatory first, okay? I don't know that I want to spend a whole heck of a lot of time, and I might be a little bit, actually, let's start with my let's talk. Okay. Loan originations, title orders. Rich, what are you thinking? Are you guys projecting?
Refinance orders off 40% year to year, 17 to 18. Resale transactions up 7%. Sales prices up, who knows, but up. And on your interest rates, just read a quote from a previous Fed chair that said what we're experiencing is a gradual unwinding of stimulus. Thought that was an interesting comment. And Chairman Powell also said that he sees no overheating in the economy. So I don't think they're going to be blowing interest rates up any faster than 3 or 4 times a year.
But a 40% decrease in refis
Right.
for you guys, I'm assuming translates into a 40% decrease. Seems like it would be larger than 40%, no? What's your refi? You're shaking your. What's your refi business looking at?
Typically, our refinance business is about 30% of our overall book of business. So, and I think a lot of depends on what your business model is. There are lenders that are out there that are call centers that have a 90% refinance rate. They're definitely changing their entire model as we speak, and they're the ones that'll be in real estate offices looking for business. But a lot of the lenders that have been in business for many, many years realize that their bread and butter is consistent purchase money transactions.
Okay, but Rich is saying refi business was down 40. You're saying your business
will be down in
will be
18
down.
from
Will be
17.
down. Okay, well that's got to have an impact on your guys' numbers. I mean,
Well, you adjust for it, and you move people into the sales side, where you've got the 7% increase in volume plus fee per file as your premiums go up with sales price, and we're going to be good.
feel good about that.
Yeah.
Ed, you talked about cash out refis. You guys doing any cash out refis?
Well, that's about most all the refis we're doing. The people that are refinancing now are people that waited too long or couldn't go during the time because their value wasn't there to refinance earlier when the rates were down, or they just had some other circumstance, bankruptcy or foreclosures, that prohibited them. Now people need cash. They're doing cash out refinances, and now you got the baby boomers coming in and reverse mortgages stepping in.
Okay, I'll talk a little bit about regulation. You mentioned Dodd-Frank, or actually, maybe you didn't mention Dodd-Frank. You mentioned CFPB. So where are we with CFPB? I mean, last I heard, the rules haven't even been written. The thing's been in place, and we're still waiting on regulations to be wrote.
You know what, I made a prediction when Trump got elected that CFPB would go away within a few years, and my operations manager told me, no way, you're full of it. There's no way it's ever going away. I fired her about a month ago.
So she went away. Well, all right.
I don't think CFPB is going away, but they no longer see our industry as horrible demon Satan people, and they want to work with us, hopefully, and it's what I'm feeling at this point, instead of against us, and I think that's good for consumers and our industry.
We're probably getting into the tall grass here. The PHH, that thing's done. That thing got dismissed and pushed away. CFPB went after PHH and gave him like a $10 trillion fine or attempted. I don't remember what it was. A ridiculous amount. You got an answer to that? What happened? To that?
Yeah, they did reverse, and they also at the same time were looking at trying to unwind the CFPB in that decision, and that did not float. I just want back to the CFPB. I do think that they will not look at us as the demons that we were, because there's been so much correction made, and Wall Street was kind of driven out of the mortgage business. Now they're going after the real estate business, so we'll see what they do in that industry. But we still have a lot of other regulators, and I think that's what a lot of people don't realize. You know, banks, credit unions, mortgage companies, mortgage brokers, there's not one regulator. Some of us have 5 or 10 regulators that all take turns knocking on the door.
Okay, everybody remembers TRID, right? 2 years ago, we were freaking out about TRID. I don't know. It's not even a topic of discussion in my office anymore. So I don't want to spend a lot of time on it. But just let's go down the panel real quick. And obviously, Rich, from the title and escrow side, that impacts you guys as well. So, zero impact. No big deal.
It's not a big deal. There is a bill that just went in to adjust a few things, and the Senate approved, I think, and it's in Congress. But TRID is not a big issue. You have to comply. We all know what to do, and it's changed the business some, but not a big impact going forward.
Well, I can just speak for myself and my office. I think we all were expecting a little bit of delay in closings and all the rest of that sort of stuff with getting CDs out. And I don't know. I think in the very beginning there might have been a couple of loan officers that blamed it on something or other, but I just don't see it happening. So, okay, so let's just real quick on TRID, let's get off it.
We made the adjustments, and now what used to be the end of the month crunch is now the third week in the month crunch. So you got to get CDs out, or there's no chance you're closing it. So,
but your guys' costs go up because of that with the TRID regulations? Did it cost you more?
Yeah, huge.
And you just pass it on to the consumer, of course.
Not
Well,
yet. We're working on it.
Well, I mean, what else are you going to do? I mean, I don't know what their margins are, but you know, when the costs go up, someone's got to pay for it. So, okay, we got a little bit of time left, and I've kind of somewhat exhausted the questions. Although I do want to hit these really, really quick. And then Rich was kind enough to prepare a PowerPoint, and I literally we could spend 4 hours going through Rich's PowerPoint. And since frankly Ed and Gary have already had a little bit of time, I want to just answer these 2 questions at the bottom, and then I want to pull up some of Rich's PowerPoint and kind of go through it and give him a chance to kind of talk about it, because I found it extremely interesting. If I had known you were going to send that to me, I would have canceled the rest of the agenda and would have brought you up all by yourself. So, but let's deal with these real quick. So, are we confident about 2018? And by no puppy dogs and rainbows bullshit. I mean, if you feel good, great. But if you don't, or just what do you guys feel about this year? Just from a business perspective, we can end up in better shape.
Yes. I think there's a lot of opportunity. Like I'd said earlier, everything's lined up. We don't have any real huge challenges, and we've taken on the regulations. We've taken all the other obstacles. From a lending standpoint, we're good to go and able to perform.
You feel good?
Yeah,
Feel good.
I think business will, for those that do the right things and get out there and work hard, business is still...
Anything scary? You know, other than the little guy in North Korea? Or?
Yeah, you know, what really scares me, because we, I don't know if we're a large lender, but we have 40 offices in California. We're a victim of some litigation that, we're a very litigious state. That's what concerns me.
Anybody been sued in the last year? Only, raise your hand. And only three of you in the
Go back
audience?
a couple of years. And
Yeah, we've
I
all
can-
been sued.
Then I
Yeah.
can do this.
Yeah, it's no fun. Rich, what do you think for the year?
Rainbows and puppy dogs. We see a good year. We think there's great opportunity. The challenges have been talked about up here already, affordability and availability. And if we get to the slides, I can talk more about those
And we're
too.
going to in less than a minute. Ed, feeling good?
I think interest rates are going to make things a little tense, and that for the buyers are a little tense. For the realtors, a little tense. You have to have a little more urgency. I know for us, I'm teaching my guys, create those relationships. Stop relying on internet and Facebook. If the only specialness that your borrower and your realtor know is your email address and your Facebook page, they don't know that you're not getting advantage of the specialness of you. And I say, hey, what's special about me is me, and what's special about you guys is you. I just didn't get a chance, as Lance interrupted me. I was going to have some audience participation. Fill in the blank. But I think
You knew I was going to interrupt. The light was red.
well, I said, hey, Ito no-showed so I could have
Yeah,
some more
but I
time.
went too long. The girls have been beating me up ever since the.
So no, I'm just teasing you. So I think we're pushing those things out. I think realtors can't afford to lose commission checks, and I think that's what we're concentrating on is that, hey, there's some non-QM products out there that will allow, that are actually some of them work, bank statement loans, one day out of bankruptcies, one day out of foreclosures, that a lot of people actually get out of foreclosures or out of bankruptcies and they actually have money in the bank. They can actually buy with the rates that aren't 12%. So we're concentrating on that, teaching our guys that so they have it available, and connect with your realtors and create some partnerships so that when the internet is coming when the internet is trying to steal your buyers from you and they happen to call us, hey Jen, your buyer is shopping. You need to touch base. Hey Mike, your buyer is asking me about a listing that's on the internet. You need to touch base with them and just keep it connected. And you need
Service goes a long way.
Exactly.
I want to just throw one thing about interest rates. For those of you, I'm trying to remember what year this was. When were rates still in the sixes, low, mid sixes? It was 2009, 8-ish. Okay, well, let's just pretend it was 2009 or 8. All I know is that we were in a cycle and things were bad. And I'm real involved in NAR and CR at the time. And if you guys remember, if you were in business at that time, the solution to our downturn in market was if we could just get interest rates to 5. If we could get them to 5, everything would be fine. And then ultimately, we were drop, and we obviously shot way past 5. And I just find it interesting for those of us, and I'm in the category, I'm a little nervous about accelerating interest rates, but then I just think they're not even at 5. And if that scares me, a 5% interest rate, man, that doesn't say a whole lot of good stuff. Okay, so this is what I want to do. We got about 5 minutes, and I want to try, if I'm hit the right button. Oh, wait a minute. Okay, now this is the deal. I think I went past it. Is that the first one, Rich? Yep. It is the first one. Okay, well, I might need you guys some help to hit the second one. Oops, I'm sorry, my clicker's passing up. Okay, so I'm going to let you, they're your slides. Let me let you speak to them real quick and tell us what's on your mind.
30 seconds per slide.
Yeah, well, this is 4 hours, but yeah, 30 seconds a line.
So, national economy and real estate market. I get up at 3 in the morning, so I got nothing better to do but look this stuff up. So, if it helps you, good. You can get a copy of this and read it later. Unemployment's low, down to 4.1%. Job report this morning from ADP, 235,000 new jobs in February versus an expectation of 190 is great. Wage growth, 2.9% in January, year over year, best in a long time. February wage growth comes out this week, so pay attention in the next few days. Interest rates, we said everything we need to say about that. Tax reform, I think, has had a positive impact on real estate market and our economy, more importantly. Small business optimism is amazing. Every single statistic I looked at on the national economy was a positive thing. So we can go to the next slide. The national real estate market, Fannie Mae Home Purchase Sentiment Index, all-time high, 89.5 in January of that's actually should be 2018, sorry. The National Home Builder Index, and this is important because we need those guys to build homes to fill the gap on availability, and we talked about that earlier too. And we see that starting to happen. We have a great builder division, and our home builders are going to be selling more new homes this year than they have in, gosh, 10, 12 years.
There's
So-
a lot of stuff going
yeah,
on out there on
a
that
lot
side.
going on. Millennials, I think, are starting to enter the market. They've been a segment of the buyer market. I think if you're not paying attention to millennials as a real estate agent or brokerage, you're missing something, because the coming years, those guys that grew up with an iPhone in their hand and video games are going to be buying a lot of homes. So pay attention to that. Next slide. Challenges, availability and affordability, and we've been talking about it, but availability, I think, requires you guys to all either sell a home or list somebody else's, and new home building is slowly improving. So I think that'll fill the gap a little bit. Prices and affordability, I think that does require the jobs, and they're coming. They need to come to the Inland Empire for all of us, right? And we need wage growth. People have to have a job, and they have to be making more money to afford the price of homes out there. So that's a challenge to overcome with jobs and economic progress in the Inland Empire.
Is there another slide past that? Or
Yes.
There is. Okay, let's get that. I don't have my previewer.
There's one more.
There we
you
go.
Actually, so there's two more. So Inland Empire housing market, we can move by that. We've talked about everything there already. Last
Okay.
one is title industry. So the title industry, you get title policies when you buy a house. Capital and surplus is robust. $4.4 billion in capital and surplus, so the title insurers are in the best position to pay claims that they've been in a long time, but don't file any, please. 7 consecutive profitable years, claims experience is improving, so in a good economy, title claims aren't filed. People find title problems in 2008 and 9, right? They don't find them in 2018 unless there's a real serious one. We expect title orders from purchase to be up 7%, and refinance activity, I said slow by 30%, but it looks like 40 at the moment since I did this slide. Title industry, we're here to help you, just like Ed was talking about. The best thing we can do is help you perform better for your consumer clients, and that's what we're committed to and working hard at.
Yeah, as you can tell, Rich didn't spend any time putting these numbers together. You probably just don't even, just every now and then you just look at them and just figure out,
Nothing
I'll
to do
go-
at 3 in the morning.
Exactly. Interestingly enough, I haven't talked to Dr. Husing, but he'll be coming up here very shortly, and he always seems to have his little piece on employment in the Inland Empire and, where we are with that segment and, blue collar and all the rest of that. So it'll be interesting to see what his forecast for employment in the Inland Empire is. It appears as
Ito
though
would
it's
have
better.
been here, because I think what he's doing is bringing jobs.
Yeah. Well, Ito actually may be here. We'll have to do a truncated version of him, but he's trying to get here, and I might try to sandwich him in between Chris and Chris Thornburg and Dr. Husing, but we'll see. Yeah. So you guys feel pretty good, right?
In general, yeah.
Yes, yeah, we think it's going to be a good year.
I've been sitting on my phone. I don't know. Has anybody texted something that's just got to be answered? Raise your hand. No, I got a couple here. Let's see if I can just find one really, really quick. I don't know if this question works for you guys. This blockchain technology, that's the whole crypto. You guys are not touching that with a 10-foot pole, right? Nobody's going to get title insurance on a Bitcoin purchase.
Well, Bitcoin is starting the recording process in France. It's the first time it's going to be experimented with for recording. That just was announced this week. And somewhere along the line, for go-forward transactions, blockchain is probably going to have an impact on recording deeds and documents.
Is that
And-
something you could see yourself insuring? Why, or do you really care?
Well,
Because you're insuring the title.
The theory is, by the people behind blockchain, is that it eliminates the need for title insurance. Don't see that happening anytime soon, because it's not backward looking. It's forward. Someday when you've got 20 years of blockchain recordings, you might be able to do it. But
So you would not be in favor of blockchain purchases?
we'll figure out how to. They're going to need what we do. So we'll figure out how to.
Has
adapt.
anybody had anything to do with that, or really know anybody who actually did a cryptocurrency transaction? I got one hand over there. Huh, interesting.
We've insured 3 transactions where bitcoins were part of the purchase price. We had to make sure it was outside of escrow is the problem. We did not want to run those through our trust account.
Yeah,
Crazy.
Fannie Mae said they won't. Fannie Mae said they won't recognize Bitcoin as reserves, or as you're trying to track money, they're not recognizing it yet. And so far, I've asked all kinds of people who's telling me what a great, exciting investment it is to explain it, and I hear blockchain technology, cryptocurrency, can't be altered, but nobody else knows what's behind it. And the guy who's trying to push me hardest goes, hey, it's going up. It went from 4,500 up to 20,000, 22,000. I don't see it having a bubble until 22. Next day, it dropped down to about 9,000.
Interesting.
And the Fed is selling a whole bunch of them that were stolen. I don't know how. That
How do you
doesn't
steal
rate-
Bitcoin?
you know,
Stole them.
Hundreds of millions of dollars worth of Bitcoins have been stolen, yes. Check that out.
I know nothing about it. I don't know. Maybe we need to take a peek at it.
Somebody
Okay.
emailed one.
Give them a hand, guys. Thank you very much, gentlemen.
All right, I got one slide for you guys because the attention span at this point has got to be getting pretty small. And the writing is even smaller. I'll make it easy for you guys. If you can see the red line on the chart, the red line is what people can actually afford to buy. It's the current interest rate combined with the median income. It's 1/3 of their gross income per month. I mean, that's a rule of thumb. It gives us a reasonable understanding of what the market should look like if it acted logically, which it doesn't. The second line, the green line, is which one's that? I just did this yesterday. That's the median sales price payment. So these are all based on payment. So the green line is where payment was based on the same formula with median sales price. If you see, let's see, it starts in 2006, so in 2008 and 9, the green line starts dropping really, really far below the red line. And that shows how ridiculously affordable the market was despite nobody buying. Now, the black line is based on 75% of market rents. That's the monthly income from the rent. And the blue line is based on what it would, if you could buy it at the rebuild cost, what would your payment be? Now, if all of us had this chart in 2009, we would have known everything the hedge funds did. It predicts perfectly where they started buying and when they stopped buying because of yield. In 2009 through about 2012, and they really stopped at 13 and 14 because they pushed the yield as far as they could, it was obvious to them that there was always a replacement buyer when they went to sell. If you can buy it cheaper than you can build it, obviously there's a replacement buyer. If you can buy it cheaper than you can rent it, obviously there's a replacement buyer or a tenant. And if you can buy it cheaper than somebody could buy it on a conventional 30-year mortgage, clearly there's a replacement buyer. So we're putting this together nationwide. The idea is that you're going to be able to jump into every MSA and tell exactly where it is in the market. The only concept I haven't gone over is the end game. So based on moderate wage increases, 0.25% increases in rates, and the market sales staying relatively the same, somewhere around 2021 looks like to be where the affordable line crosses the current line. And that technically should mean some kind of market turn or correction. However, if you guys are reading Bruce Norris's reports, you'll know that he talks about the echo boomers coming online in 2020 to 2025. Those are the peak spending years. So that will dramatically affect the way our market changes or the way our market operates once those people come online. My current estimate, kind of what we're looking at, is somewhere around the 2020, 2021, sort of like no longer safe to invest in the Inland Empire. After that, it's sort of like a all speculation game. That's all I got.
I mean, I'm old enough to go back to when we used acetate over things. Okay, let's see what happens. All right, there it is. Let me start out by asking a question. After everything you've been hearing, how many of you think 2018 is going to be a great year? Raise your hand. How many of you think it's going to be average? A few. Terrible. That's the forecast. Thank you very much. Okay, what I'm going to take a look at is this. First of all, briefly, the U.S. economy. Secondly, very, very briefly, California, because they set the ocean of forces that the Inland Empire swims in. From then on, I'm going to look in depth at the Inland Empire. This particular graph is about the U.S. What it shows is our country lost 5.7% of all its jobs, a total of 7.78 million jobs during the Great Recession. Huge downturn. What's happened subsequently is we've brought back 16,600,000. That's through the Obama administration and the beginning of the Trump administration. The result of that is we now are 8.4 million jobs higher than we were before the Great Recession. What that represents is we're 6.4% higher than we've ever been. Now, please remember 6.4 because I'm old and I don't remember numbers. My short-term memory is gone. So I'll be asking you about that in a second. Now, looking at a couple of other metrics on the U.S. economy. Unemployment at the height was 10.6 in the country. It is now 4.1. So it's come down dramatically. However, that doesn't include two groups of people. It doesn't include people who are working part-time but want full-time work. And it doesn't include people who just dropped out and haven't been looking lately. That number peaked at 18%. It's now down to 8%. So let's see where that looks when we go back to the last great boom. And what you see is we are roughly exactly where we were when unemployment was at full employment in the last big boom on either way of looking at it. So effectively, we can call where we are full employment. Now, this creates a problem for us. Think of having a car. I have a BMW that's really hot outside, and I take it up to red line, and then I stomp on the accelerator. What's going to happen? You're going to blow the engine. That's the great fear about where we sit right now with the tax cut, because the tax cut is stimulative. And you're stimulating at a time when you're already at full employment. And that potentially has consequences. Now, inflation, 2.1% on the CPI, last available number. By the way, in California, it's 3.5. Our inflation has been faster than the country as a whole. But those kinds of numbers means the Fed is beginning to see price increases up in the range they were always looking for. Now, they've talked about 3 increases in the short-term rate, which is what they control. Now they're talking perhaps about 4. That was one of the things that caused a market wiggle this last week or so. Now, this is where the short-term rate just was 2.89%. Now, what tracks that almost by, well, you'll see. See how close it tracks? That's the 30-year fixed mortgage at 4.22. It is probably headed for 5, but you can see how they're bending there at the end, how interest rates are now going up, which of course affects the ability to do real estate transactions. Now, Janet Yellen started the process of unwinding QEs. When they bought all these mortgage-backed securities, they're now slowly selling them off. Jerome Powell is going to continue that process. That is one of the things that affects longer rates. A strange thing that also affects longer rates is the fact that when you have a company that has money overseas that they've held over there so that they didn't have to pay taxes on it, and under the new tax bill they can bring it back, understand that money was not in a warehouse someplace. They had it invested, and a lot of that was vested in government securities, U.S. government securities, because they're secure and they pay a rate of interest. Now, if you bring that money back and spend it, you're going to sell those securities. That will also affect the long end of the market. So both the short end and the long end of the market, there are factors in play that are going to affect them. Now, Generally, though, when you look at the U.S. economy, what you see is it is really firing on all cylinders. This is good as it gets. We're now going to push it faster. We've never done this before in this particular way, so it's going to be very interesting. The key thing to watch is, in fact, what happens to price increases, because that is generally what occurs when you speed things up when you're already at full employment. And so that is the difficulty that's in the equation. Now, moving on, looking at the state of California. We also had problems in the state. We lost a bigger share of our jobs than the country. We went down 7.5%. That is roughly 1.2 million jobs lost in the state. What's happened since? We've added back 2.53 million jobs, so more than double what we lost. And the state is now 1,352,000 higher than ever before. Not only that, it's up 8.5 from where it was. Now, what was the number I asked you to remember? 6.4 for the country. California's up 8.5. Now, trying to remember the 8.5 as well. Two numbers is really tough for me. So that 8.5 shows the state outperforming the country. Now, going down the Inland Empire, here just as to know something about our area that not very many people know. We have a population of 4.56 million people. So what? On the right there, altogether, there are 25 states with less people than the Inland Empire. Half the country has smaller population than these two counties out here. Notice two over, Kentucky's the one we just passed. Oregon, we're 400,000 people. 400,000 people larger than the state of Oregon. Who's next? Next, we're going to pass Louisiana. So this is not some minor little market next to LA. As a state, we would be huge within the country. I had the opportunity to brief our newest U.S. Senator, and I said, you know, when you're talking to your colleagues, half of them represent states smaller than the two counties you're standing in, which really gives you a feel of the power here. Now, what happened here? Well, we lost 10.8% of our jobs. So more than the country, more than the state in this area. We got clobbered in the recession. We lost 140,000 jobs. What's happened since? We've brought back 292,000 jobs. That's from 2011 through 2017, so approaching 300,000. And it puts us 151,000 jobs higher than we've ever been. Altogether, we're up 11.6. Now, what was the first number? 6.4. The second one? Just so I could remember them, I put them in here. But what you see there is we're outperforming the state, which is outperforming the country. So this area is revved up tight and doing really, really well. What about job quality? There we have an issue and a non-issue. Issue is the high end of the economy. On the left, the state, during that 2011 to 2017 turnaround and expansion, 26% of the jobs over 60,000. Our area, only 10.8. And almost all of those are in healthcare. So we're not doing well at that end. If we go over and look at the blue-collar sectors, what do we see there? The state, 20.8%. The Inland Empire, 41.5% of our job growth is construction, manufacturing, and logistics and distribution. So those sectors are booming here. They pay 45 to 60,000 at the median, meaning half the people working in those sectors make more than that, half make less than that. So that is unusually broad versus the state. The odd result, which is one that is surprising to most people, is what about low-paying jobs as a share? State, 46% of all the jobs created pay 30,000 and below, whereas in this area, it's 40%. So we've way outdone the state because we have a broader middle. We don't have a good high, we We have a broad middle. That gets ignored by a lot of commentators who they tend to look at the high-paying piece and ignore that broad middle. What the state has managed to do is to hollow out the middle. A lot of high-paying jobs, a lot more low-paying jobs coming out of state policy. One of the things that you will find out is I used to be a political campaign manager for a living. I worked for the Democrats. I elected members to the state assembly. Today, I am a registered nonpartisan. I hate everybody. Now, when we look at this, these are job growth 2016 to 2017, Inland Empire, 46,600. Look to the left of there. LA, San Diego, Orange, Ventura, lower than the Inland Empire last year. This region is really a job powerhouse. When we look at the state and we look at metro areas, there's a lot of two-county metro areas. We added 43,052 jobs from the period 2016 to 2017. LA added 56,875, so we, in that long period of time, we're behind them. Excuse me, that should be 2011 to 2017. No, that's 2016, 2017. Who's behind us? San Francisco, San Mateo. Who's behind them? San Diego. Then down Silicon Valley. What's that picture tell you? Job growth is in the South. The people in Silicon Valley and San Francisco and San Mateo think they are the center of the universe. They are not. We are, at least when it comes to job growth. Our median pay in this area, half below, 40,965 in May of 2016. How does that compare? Las Vegas is about tied with us, as is Dallas. If you look way off on the left, you see Seattle, Sacramento, San Diego, LA, Portland are higher paying on the average, so we have a competitive advantage when we're competing against those areas to bring jobs down here. Interesting about the unemployment rate here, if you go back to the worst of the recession, we're all the way up to over 14% unemployed on the regular definition. The U.S. peaked at 10, so we were way worse than the U.S. Where are we now? These are unadjusted figures. This is just the raw data. We're at 4.1, the country was at 3.9. The adjustments for seasonality aren't in these, but you could see that we've now moved back to where we used to be, which is tracking the country as a whole, as you see over there back in the early parts of the 2000s. We have two issues that are tough for us. Issue number one, the share living in poverty. 2016, it was 23.5% in the Inland Empire, 29% in the Central Valley. But when you think about it, these are children, this is for children under 18 living in families. Roughly a quarter of them are living below the poverty line. That means they've got to fight poverty before they ever get in a classroom, and they are our future labor force. That is a huge issue for us. For all of us, the number is 16.4. It has been improving, but still 16.4 is still very, very high. So that's one of our issues. Related to that is educational attainment. And this really affects what kind of jobs come to an area. If you look there, 46.3% of our population, high school or less. I'll say that again, high school or less. Almost half are adults. That means the kinds of jobs that can grow here in quantity have to be able to be available to about half of our population. When we look at AA or higher, we're at 29.2, much better than it used to be, but still way below the coastal counties that we compete with. And look over there on the right, the Bay Area. 50% of the adult population has an associate's degree from a community college or a bachelor's degree or higher. That's where policy is set in the state of California by thinkers in the Bay Area who write about areas like this like they knew something about us, when everybody they know has a degree of some sort or other. It really creates an imbalance in the way legislation gets created up in Sacramento. Now, let us assume for a moment that we are in the future and we are on the moon. And a rocket has come and brought us payroll for our mining company on the moon. Now, what do miners do with their money? Well, they need things. What do they need? Well, first of all, they need food. So we open a pizza parlor on the moon. No mine, no pizza parlor. They want entertainment, so we have the Moon nightclub on the moon. Nobody works at the nightclub unless you have the mine. The mine is the key to everything that's going on here. That is the way a regional economy works. You ask the question, what's bringing the money that then moves through the rest of the economy? First and foremost in the Inland Empire, it is in fact logistics and distribution. All you've got to do is drive around and you see that with all the large facilities. That then brings the money that supports people like hairstylists, people that work in retail. These sorts of operations only exist because the money is coming here because of operations like logistics or like healthcare or, whoops, I just killed it. Back up, back up, back up. Healthcare, construction, hugely important. Manufacturing, hugely important. That's California Steel in Fontana. And then high-end non-medical sections of the economy. Those are the major sectors bringing the dollars, ending up in the equivalent of our pizza parlor and nightclubs. Now, looking at each one of those. First of all, looking at healthcare demand. One of the effects of the Affordable Care Act, if you look in 2012, in the Inland Empire, there were 750,957 people without health care, according to the census. That is down to 336,000. It has dropped 55%. It has gone from 28.8% of our population down to 12.4%. Now that was as of 2016. The 2017 numbers won't be available until September. The point being, it has increased demand for healthcare services. Second, this is the number of people for each healthcare worker in California. 26.6 people for each healthcare worker. That's what it is in the Inland Empire, 33.5. So we have 26% more people for each healthcare worker. Now you know this. You've been to emergency lately? Yeah, they have tents outside during the flu epidemic. The fact is our healthcare sector is overwhelmed, so it needs to expand. So it needs to expand because it's always been underserved or understaffed, but now with the ACA, it's even more understaffed. So this is a sector we expect to see a lot of job growth in. 10.8% of all the jobs created 2011 to 2017 were in healthcare, and the nice thing about it, it's our strongest high-paying sector in terms of adding jobs, that 31,320 or 237 jobs. Median pay in the sector, $60,007. Now you may think that's low for a sector, but remember, when you go to a hospital, you're not spending all your time with doctors. You've got sonographers, you've got people that are doing MRIs, you've got people that are checking you in. You have all the people that do billings and all that end of it. So the sector has a huge number of jobs in it. Median pay $60,000, middle class in terms of where it puts families. Then there are the biggest sector in terms of growth, the sophisticated warehousing operations. Here we go to the ports of LA and Long Beach. And what do we find? Coming in 8.6 million loaded containers. Now, a lot of people, when they talk about economics, focus on exports and the need to drive that. Not in the Inland Empire. What we do is we handle imports. And so 8.6 million 20-foot equivalent containers, the goods come in, a huge share come here and end up in our warehousing and distribution facilities. Exports, not so high, 3.4. It has always been much lower than the import side. Now, this is a huge driver for our particular economy. Now, I have to take serious exception to what was said about what's taking place with tariffs, without swearing. The fact of the matter is, if we set off a trade war, it is going to badly affect international trade, which puts a bullseye on the Inland Empire's strongest sector. This is not helpful to this particular region where imports are so overwhelmingly important as part of the driving of our economy. Looking at how important, we'll see in a second, because there's a different thing. Who in here did not buy something online last year? Raise your hand. 1, 2, 3, 4. 4 people lose their American citizenship. The fact of the matter is, that's what we do now. It's been growing at 15 to 16% compounded. How would you like your IRA or your savings be going up at 15% a year without having to think about it? It's gone from 1.1% to 9.1% of all goods. Now, where is that locating? Here. Why? Because it's got room for it. Go find me 50 acres of flat land in LA County, because that's what it takes to build a 1 million square foot facility. There isn't any. Go to Orange. Are you kidding? Go to San Diego. They've zoned it out of existence, even if it could have existed. So we are the backbone of it. Net absorption of space. 19.4 million square feet absorbed last year. Huge. We're second place in the U.S. Honestly, who cares? They're so far behind us, they don't count. 3.7% is now the vacancy rate. It's just jumped up a little bit. Why? Because we just finished building a couple of more facilities. This is booming. Ido Benzivi, this is the part of the economy that he exists in. This is what's going on with industrial rates and vacancies, and you can see the Inland Empire has a competitive advantage in terms of cost per square foot a month. Now, where is stuff being built? Inland Empire, 73.8% of all construction going on of industrial facilities in December of last year. That particular number, who's second to there? Again, who cares? It happens to be LA County, but they're a minor player in this. They're down at 15.3%. So this is a huge strength for this particular economy. Lease rates have gone up 22% above where they were before the recession. They're up 76.7% since the bottom of the recession. So lease rates doing very, very well. Then there's Ontario Airport. One of the hardest things we fought to do was get it away from LAWA, LA World Airports. LAWA is a branch of the city of Los Angeles. They essentially emasculated Ontario Airport to pull the service to LAX to pay for the expansion there, and just about destroyed Ontario Airport. They no longer own it, we do. I made the terrible mistake in a speech like this one day with press available of saying, as far as I was concerned, the LAWA board should burn in hell. Haven't done a lot of work in LA since then. But you can see in 2017, we were up 15.5% to an all-time record level of cargo going through Ontario International. So it's doing very well. A lot of that is UPS, some of it is FedEx. Now, logistics job growth, round figures, 2011 to 2017, 60,000. So we almost grew 300,000. 20.4% of it was in logistics alone. That doesn't include multipliers. Now you take the staff of, say, Amazon.com. Amazon has over 16,000 employees. They go and spend at Stater Brothers. They go and spend at the hairstylist or wherever. It's also affecting that part of the economy. The result is probably as much as 35 or 40% of the economy driven by that one sector. You've got people who want to shut this sector's growth down. Essentially what they are saying is they wish we'd have stayed in the Depression in this particular reason, because without it, we never would have gotten to the kind of numbers we've looked at. Median pay in this sector, 46,708, half above, half below. That's not what people start at. They start with little educational background down around $12, $13 an hour.